The tri-star pattern is a significant indicator in the realm of technical analysis, suggesting a potential reversal in the market. This pattern is relatively rare, but when it appears, it garners the attention of traders due to its predictive qualities. The tri-star pattern consists of 3 doji candles, each representing a day where the opening and closing prices are very close to one another, indicating indecision among traders. The occurrence of this pattern is seen as a harbinger of a shift in market sentiment, suggesting that the prevailing trend may be about to change direction. The first doji suggests that the current trend is losing momentum. The second doji, appearing after a gap, underscores the market's indecision. The third doji, following another gap but in the opposite direction, signals the potential beginning of a new trend. Navigating the market's celestial seas, a term playfully alluding to the vast and unpredictable nature of financial markets, can be daunting. The use of chart patterns like the tri-star contributes to a strategic approach to trading. These patterns, akin to celestial navigation tools of the past, help traders to predict market movements and make informed decisions. Though technical analysis involves interpreting numerous chart patterns and indicators, understanding the significance of a tri-star pattern is beneficial for those looking to anticipate market reversals. This knowledge, when combined with other analysis tools and a clear trading strategy, can significantly improve one's ability to navigate the complexities of the financial markets. The unique 3-river bottom is a bullish reversal pattern found in candlestick charting, typically used in technical analysis of financial markets. This pattern suggests that a current downtrend in the price of an asset may be about to reverse, indicating the potential for a bullish or upward movement in price. Imagine looking at a chart and seeing a series of candles. These candles represent price movements within a certain period. For the unique 3-river bottom to form, specific conditions must be met over 3 consecutive periods. First, during a downtrend, a long black or red candle appears, suggesting strong selling pressure. The second candle opens lower than the previous close, further pushing the price down, but closes in the middle of the day's trading range, indicating that selling pressure is starting to wane. The third candle is where the magic happens. It gaps lower, opening below the second candle, but then reverses and closes above the close of the second candle. This final step signals that buyers have taken control, and a reversal upwards is likely. This pattern gets its name from the imagery of the second candle forming a riverbed with the first and third candles acting like the banks of a river, cradling the bottoming price action. Investors and traders who recognize this pattern could see it as an opportunity to buy into the asset, expecting prices to rise soon after this pattern forms. Understanding the unique 3-river bottom can be beneficial for those looking to spot early signs of a market reversal from a downtrend to an uptrend, potentially allowing for timely investment decisions that capitalize on upwards price movements. Identifying the unique 3-river bottom is a process that involves observing distinct patterns in the price movement of a stock or financial asset over 3 trading sessions. This pattern is known for indicating a potential bullish reversal, meaning it suggests that the price of the asset may start to rise. The initial step involves identifying a long downward trend that signals the asset is in a bearish phase. The first part of the unique 3-river bottom pattern is a long black or red candle representing a day with a significant price drop. This drop confirms the continuation of the bearish trend. On the second day, the market opens lower than the closing of the first day, creating a gap. However, by the end of the trading session, the price manages to close slightly above or at the low of the previous day, forming a smaller candle. This activity hints at a slowing down in the bearish momentum. The third day is critical in confirming the pattern. It features a small candle with an opening price within the body of the second day's candle and closes higher than the previous 2 days, but still below the opening price of the first day. This arrangement resembles a river flowing around obstacles, hence the pattern's name. The closing of the third day higher than the opening initiates a change in market sentiment from bearish to bullish. Investors interpret this pattern as a signal that selling pressure is diminishing and buying interest is increasing, potentially leading to an upward price movement. In summary, identifying the unique three-river bottom involves looking for a specific 3-day price movement that signifies a transition from a downward trend to potential bullish momentum. This understanding helps investors anticipate possible reversals in the market, offering strategic entry points for those looking to capitalize on the early stages of an uptrend. The unique three-river bottom is a bullish reversal pattern, indicating a potential shift from a downward to an upward market trend. This pattern is recognized by its distinctive formation on the candlestick chart, consisting of 3 specific candle shapes that appear at the end of a downward trend. The first is a long red candle, which is followed by a smaller candle that gaps down, and finally, a long green candle that closes within the body of the first candle. This sequence suggests that the market sentiment is changing, with selling pressure starting to decrease and buying pressure beginning to increase. Market sentiment plays a critical role in the formation of the unique three-river bottom pattern. Initially, the sentiment is bearish, as indicated by the downward trend and the appearance of the first red candle. However, the gap down that follows shows that while the market may open lower, the lack of further downward movement and the subsequent increase in price reflected by the green candle indicate a shift towards a more bullish sentiment. This change is significant because it signals to investors that the market might be starting to recover, suggesting a potential turning point. Therefore, recognizing this pattern can be valuable for investors looking to enter the market at the beginning of an upward trend. The unique three-river bottom pattern is a technical analysis tool used to predict a bullish reversal in the market. It signifies a potential shift from a downtrend to an uptrend. This pattern is classified under the category of bullish reversal patterns, which are crucial for investors looking to capitalize on shifts in market momentum. Imagine observing a river flowing downwards, symbolizing a market in decline. The unique three-river bottom pattern is akin to spotting a sequence of rocks that suggests the river's flow is about to change direction and move upstream. This pattern comprises 3 key candlesticks on a price chart, each representing a day's trading in this metaphor. The first candlestick is a long, black one, which shows that the sellers are still in control, pushing prices down. This is followed by a smaller candlestick that can either be black or white, indicating uncertainty or a slowdown in the downtrend. It's like the water's flow weakening as it hits a large rock. The third candlestick is a long, white one, closing above the second day's open, but still within the range of the first day's prices. This signals that buyers are gaining strength, potentially reversing the trend towards a rise as the river finds a new path upwards. In simple terms, the unique three-river bottom pattern helps traders and investors identify a moment when the market's downward trend may be losing steam and an upward trend might be starting. Recognizing this pattern allows them to make informed decisions about entering the market at a potentially advantageous time, aiming to benefit from the anticipated upward movement. The unique three-river bottom pattern is a bullish reversal pattern used in technical analysis to predict the turning point in a downward trending market. It suggests that a positive change in market sentiment is on the horizon, leading to an upward movement in prices. Key factors for confirmation of this pattern include a specific sequence of candlesticks across 3 trading sessions. On the first day, we see a long red candlestick indicating a continuation of the bearish trend. The second day starts with a gap down, which forms a smaller red or black candle that sits within the range of the first day's candle, reflecting uncertainty in the market. The third day is marked by a long green candle that opens within the body of the second day and closes deep into the body of the first day's candle, signifying a strong buying pressure and a potential reversal of the downtrend. For investors and analysts seeking to confirm this pattern, volume plays a crucial role. An increase in trading volume on the third day compared to the previous 2 days can serve as a strong confirmation that the bulls have taken control of the market. Additionally, it's important to look for any external factors that might influence market sentiment, such as economic news or events, as these can impact the reliability of the pattern. Understanding and identifying the unique three-river bottom pattern requires close observation of market trends and candlestick charts. While this pattern offers a potential insight into market reversals, it should be considered in conjunction with other analytical tools and market indicators to make informed investment decisions. The unique three-river bottom is a bullish reversal pattern that appears on candlestick charts, signaling the potential end of a downtrend and the beginning of an uptrend. When we explore its reliability and limitations, it's essential to consider several factors. First, the reliability of this pattern stems from its appearance after a sustained downtrend, indicating a possible exhaustion of selling pressure. This pattern is unique, composed of 3 specific candlesticks that collectively suggest a strong reversal could be imminent. It starts with a long bearish candle, followed by a smaller candle that gaps down, and then a long bullish candle that closes deep into the first candle's body. This sequence often encourages investors to interpret the formation as a sign that buyers are taking control from sellers. However, the unique three-river bottom pattern also has its limitations. Like all technical analysis tools, its prediction accuracy is not guaranteed. Market conditions, external news, and investor sentiment can all influence the price action, sometimes rendering even the most reliable patterns less effective. Therefore, traders often use this pattern in conjunction with other technical indicators and fundamental analysis to make more informed decisions. This approach helps identify confirmatory signals, reducing the likelihood of acting on false positives and improving the chances of capitalizing on genuine reversal opportunities. Understanding and recognizing the unique three-river bottom pattern allows investors to potentially spot key turning points in the market. Nonetheless, it's crucial to approach this and any technical pattern with a balanced perspective, considering both its strengths and its inherent limitations. The unique three-river bottom is identified as a bullish reversal pattern occurring in a chart where prices are depicted. It is characterized by a specific sequence of price movements over 3 days. The initial day shows a long black or red candle, indicating a strong downward trend. The second day opens lower than the previous close, but closes in a narrow range near its open, forming a small candle. This pattern culminates on the third day with a strong white or green candle that opens well within the body of the first day and closes above the first day's close, signaling a potential reversal from a bearish to a bullish market. Integration with other analysis tools enhances the predictive power and reliability of the unique three-river bottom pattern. By combining this pattern with other technical analysis tools such as volume indicators, moving averages, or momentum oscillators, traders can confirm the reversal signal and assess the strength behind the potential upward movement. For instance, an increase in volume on the third day of the pattern may confirm buying interest and the likelihood of a bullish reversal. Similarly, a moving average crossover or bullish divergence in momentum indicators can provide additional confirmations. The integration of the unique three-river bottom pattern with complementary analysis tools aids traders and investors in making more informed and confident decisions. This approach aligns with the principle of using a combination of signals to improve the accuracy of predictions and manage risk in financial markets. The unique three-river bottom is a bullish reversal pattern that often signals the turning point from a bearish to a bullish market trend. This pattern is distinctive in its formation, resembling three consecutive price movements that collectively suggest an upcoming shift in market sentiment. In discussing common mistakes and misinterpretations associated with this pattern, it is crucial to highlight the significance of context and confirmation. One frequent error is to rely solely on this pattern for making trading decisions without considering the broader market context or waiting for additional confirmation signals. The unique three-river bottom should be viewed within the larger picture of market trends and other technical indicators to confirm the reversal. Another common oversight involves misidentifying similar patterns that do not fulfill all the criteria of the unique three-river bottom. This pattern is specific in terms of the sequence of candlesticks and their respective openings and closings. Misidentification can lead to incorrect assumptions about upcoming market movements. Further, traders may misinterpret the timing for entry based on the pattern. While it suggests a potential reversal, jumping into trades too early without observing whether the pattern fully develops or is confirmed by subsequent price action can result in premature and risky decisions. Understanding these common mistakes and approaching the unique three-river bottom with a comprehensive strategy that includes confirmation from other indicators and market analysis can significantly enhance its efficacy as a predictor of bullish reversals. The unique three-river bottom pattern is an intriguing formation you might encounter in the financial markets, particularly when analyzing stock charts. This pattern is considered a bullish reversal signal, suggesting that the current downtrend could be nearing its end and a potential uptrend may be on the horizon. To understand this pattern, visualize a scenario where the market has been in a downtrend. The unique three-river bottom appears through three key candlesticks. The first is a long red candle indicating a continuation of the bearish trend. The second candle is smaller and also usually red, opening lower than the previous close but with a long lower wick, showing that sellers pushed the price down, yet buyers managed to pull it back up, hinting at a struggle between buyers and sellers. The final candle is a longer, green candle that opens higher than the second and closes above the close of the first, signaling strong buying pressure and potential reversal. When it comes to strategies for entry and exit points subsequent to spotting a unique three-river bottom, it is crucial to wait for confirmation. A prudent approach involves observing the market for additional positive signs following the pattern's formation. An increase in volume on the day of the reversal candle can serve as confirmation. One practical tip for entry is to initiate a position after the pattern has been confirmed, ideally at the opening of the trading session following the appearance of the complete pattern. Setting a stop loss just below the lowest point of the pattern can help manage risk. As for exit strategies, it often comes down to setting target levels based on previous resistance areas or employing trailing stop losses to protect profits as the price moves favorably. Technical indicators or moving averages can also guide exiting a position, for instance, when the price crosses below a short-term moving average, suggesting a potential change in trend. Remember, while the unique three-river bottom pattern can be a powerful tool in predicting trend reversals, no pattern guarantees absolute accuracy. Combining this analysis with other indicators and a robust risk management plan can enhance the effectiveness of your trading strategy. The unique three-river bottom pattern is recognized in technical analysis as an indicator of a potential bullish reversal, signifying a shift from a downtrend to an uptrend. This pattern consists of three key candlesticks that emerge at the low point of a downward trend. To illustrate, imagine you are observing a chart. The pattern starts with a long red candlestick, followed by a smaller candlestick that opens lower but closes within the body of the previous candle, marking the second day. On the third day, a long green candlestick appears, closing well into the first day's red candlestick, suggesting a strong buying interest and potential market reversal. In the Variations and Similar Patterns section, one might discover patterns that share resemblance or serve as precursors to the unique three-river bottom, albeit with slight differences in their formation or the market conditions under which they appear. These variations can help analysts identify possible bullish reversals even when the perfect unique three-river bottom pattern does not form. Understanding these patterns and their variations is crucial for making informed investment decisions. Each variation contributes to the broader narrative of market sentiment, offering insights beyond the scope of one pattern. By recognizing these nuances, investors can better gauge when to enter or exit positions, optimizing their strategies for anticipated market movements.